Good morning and welcome to the Bulls, Bears, and the Bell podcast. It is Monday, August 10th, 2026. And if you are looking at your portfolio screens today and wondering why you are getting such wildly mixed signals, well, you are definitely not alone.
Yeah, not at all. It's a profoundly fragmented market this morning.
Right. So today we are doing a deep dive into this divided pre-market landscape. We're pulling from a massive stack of weekend institutional analyst notes, raw labor data, and even, geopolitical shipping logs to figure out exactly what is happening under the hood.
Because we are looking at a scenario where different asset classes are reacting to entirely different macroeconomic anchors, it's basically creating this violent tug of war across the indices.
Okay, let's unpack this. Because on one side of your screen, we have incredible resilience in the tech sector, right? And what looks like a massive sigh of relief over domestic interest rates.
Yeah, a huge sigh of relief.
But then on the exact other side of the screen, we're staring down a naval blockade, soaring precious metals, and just deep, deep uncertainty in global energy.
Right. It's a total split screen.
It really is. And to understand it, we actually have to trace the timeline back a few days to a very specific structural crack in the economic narrative. I'm talking about last Friday's domestic labor report.
The July jobs report. That is, that's really the gravitational center of everything happening in the U.S. markets right now.
Right. And the size of the miss is what I want to zero in on first. The consensus expectation on Wall Street was that the U.S. economy would add 80,000 jobs in July.
Which was already a fairly conservative estimate.
Exactly. But the actual number came in at just 23,000. Now, when I look at a 57,000 job discrepancy in an economy of our scale...
Sounds tiny.
Right. It almost feels like a rounding error. Yet this report has functioned less like a bucket of ice water and more like a total wrecking ball to the Federal Reserve's aggressive rate hike plans for September. Why is such a relatively small absolute number causing such intense panic?
Well, I'd argue it's not panic so much as a sudden violent repricing of institutional models.
Okay, walk me through that.
You have to remember that Wall Street doesn't trade on the absolute number of jobs, right? It trades on the trajectory.
The trend.
Exactly. A 57,000 job miss on an 80,000 expectation isn't just a rounding error. It is a 70% miss against the consensus.
Wow. Yeah, when you put it as a percentage, it sounds completely different.
Right. For months, the entire financial ecosystem has been operating under this hardened assumption that the Fed was going to maintain a tightening trajectory. But that one single data point completely shattered the consensus.
The probability models definitely reflect that. I mean, just a week ago, the odds of the Fed hiking rates in September were sitting very comfortably at 67%.
It was a pretty solid baseline.
Very solid. But as of this morning, those odds have plummeted down to exactly 44%.
Yeah.
Which brings up a critical question for you. Is a 44% probability essentially the market throwing its hands up and saying, we have absolutely no idea what happens next? Or is this a definitive trend away from tightening?
It's the former. And honestly, that ambiguity is exactly what makes this specific moment so volatile for anyone holding equities today.
Because it's a coin flip.
It is quite literally a coin flip.
Yeah.
What is critical to understand here is the mechanics of how quickly institutional certainty can dissolve. When you go from 67% certainty down to a coin flip over a single weekend...
Capital has to move.
Right. Capital is forced to reprice risk instantaneously. You don't have the luxury of waiting to see what happens.
And we are seeing that instantaneous repricing play out in the bond market right before our eyes. The 10-year Treasury note is currently holding at 4.673%.
Right. It is hovering right there, essentially trying to find equilibrium in a landscape where the primary economic...
The labor market.
Exactly. The strength of the U.S. labor market just gave way. That 4.673% yield is the market's attempt to split the difference between a Fed that might hold steady and a Fed that might be forced to cut if employment deteriorates further.
So, if Asia is rallying because of that exact same U.S. labor data, we need to bridge that gap. Because that wrecking ball that hit the U.S. rate expectations is causing a massive relief rally overseas.
Oh, absolutely massive.
Let's look at the numbers. The Nikkei 225 in Japan surged 2.53% overnight.
Breaking out.
Yeah, it cleared the 67,200 level. South Korea's Kospi followed suit, gaining 0.53%. Now, my assumption is that this isn't just about sudden optimism for Asian corporate earnings, right?
No, not at all. It is a direct mechanical relief valve opening up.
Okay. Explain the mechanics there.
To understand this, we have to look at the macroeconomic hurdles of those specific regions. Asian markets, and particularly Japan, have been under immense pressure from a highly dominant U.S. dollar.
Which is driven by those high U.S. Treasury yields we were just talking about.
Precisely.
Let me stop you there, though, because the currency dynamic can get murky for people. You're saying that because U.S. rate hike expectations drop from 67 down to 44%, the dollar weakens, which mechanically helps Asia.
Exactly. A strong dollar forces foreign central banks to defend their own currencies, which often restricts their domestic economic growth.
Right.
So when the expectation of a U.S. rate hike drops, the dollar softens. It essentially takes the boot off the neck of local currencies like the yen.
So the Nikkei surging isn't really a celebration of their own economy.
No, it is a celebration that the U.S. might finally be exporting less inflation to them.
Okay, so if the weak dollar is throwing a party for Asian equities, why isn't Europe joining in?
That is the big question today.
Because when we look across the Atlantic, it is a completely different story. The Stoxx 600 is totally flat right now.
Barely moving.
Yeah, it is sitting at plus 0.05%, just hovering around the 660.12 level. And underneath the surface, there is a serious sector split.
Yeah, a huge divergence.
European tech is up 0.7%, but European media is down 0.7%. Here's the paradox I need you to reconcile for us.
Okay, lay it on me.
The Eurozone Investor Morale Index, the Centix, it just turned positive today. It hit 0.9 points, which is the first time it has been in positive territory since early 2026.
Right.
So if their investor morale is finally positive, why is their broader market barely treading water?
It's an excellent paradox, and I think it highlights how regional markets digest the exact same U.S. macroeconomic data differently based on their own, structural vulnerability.
Meaning what, exactly?
Well, yes, Eurozone morale is ticking up, largely because they see the same interest rate relief that Asia sees, but the European economy is heavily industrialized.
Oh, right.
They are deeply structurally sensitive to global trade flows and, even more importantly, to energy costs.
Ah, so they are importing energy in a way that makes them uniquely vulnerable to what's happening today.
Precisely. Asia is getting a currency relief rally, but Europe's industrial base is staring down immediate supply chain threats.
So they can't just blindly celebrate the Fed.
Exactly. And that divergence you noted between European tech moving up and media moving down, that shows you that investors over there are aggressively cherry-picking.
Right.
They are buying the specific sectors that benefit mathematically from lower interest rates, like tech, but they are incredibly cautious about the broader consumer landscape.
Which provides the perfect connective tissue to the next piece of our puzzle. Because if the prospect of the Fed easing off the gas is theoretically good news for stocks, why are U.S. futures so mixed this morning?
Yeah, it's a messy board out there.
The S&P 500 is hovering near record highs, up just 0.1%. But the Dow Jones Industrial Average is actively getting dragged down.
Dragged heavily.
Yeah, it's off 70 points, or down about 0.18% in the pre-market. The answer, according to the geopolitical shipping logs we've been reading, lies in the commodities market, and something being referred to as the Hormuz Factor.
This is exactly where the geopolitics violently intersect with the economic data.
Right.
The Dow is industrial heavy, as we know. Industrials require raw energy to function, and right now the Strait of Hormuz is acting as a tourniquet on the global industrial supply chain.
A trickle. The institutional notes from this morning describe the crude flow through the strait as a mere trickle right now.
Which is terrifying for manufacturers.
Right. Now, just to lay out the facts neutrally for everyone listening, we have diplomatic talks happening between Iran and Oman regarding the opening of new shipping lanes.
Right, that's the latest development.
And Tehran is publicly claiming that a deal is close. However, the United States remains highly skeptical of those claims and is actively maintaining a strict naval blockade in the region.
Which changes everything.
You have a massive geopolitical stalemate halfway around the world, and it is acting as a hard ceiling on Wall Street's gains today.
And we have to analyze this purely through the lens of market forces, right?
Mm-hmm.
Regardless of the diplomatic posturing from either side, the reality on the water is a physical naval blockade and restricted shipping lanes.
It's physical reality.
Exactly. That creates an immediate, tangible supply bottleneck for global energy. We are seeing Brent crude oil up 0.9% this morning, trading at $84.32 a barrel. And it's actively testing major resistance levels.
Wait, before we move on, testing resistance is a bit of a chartist term. You mean the price of oil is hitting a historical ceiling where sellers usually step in, right?
Yeah.
And if it breaks through that ceiling, it could run significantly higher.
That is exactly what it means.
Yeah.
If Brent Crude breaks definitively above that resistance at 84.32, the cost of manufacturing and transportation spikes globally.
So oil creeping up toward $85 a barrel is just a direct tax on all those industrial companies sitting in the Dow.
A huge tax.
But the commodity that really makes me stop and stare this morning is gold.
Oh, yeah. Gold is on a tear.
It is holding extremely firm at an astronomical $4,342 an ounce. To put that in perspective for everyone, gold isn't just acting as a financial inflation hedge anymore. At over $4,300 an ounce, it's a geopolitical panic button.
I think that is, frankly, the most accurate way to frame it. When you see physical gold holding at that magnitude, even while Bitcoin, which many argue is supposed to be digital gold,
Right.
is trading totally sideways at $65,200,
Yeah.
it tells a very specific story about institutional fear.
I want to push back on that slightly, though. Why wouldn't Bitcoin be catching the exact same safe haven bid? If institutions are panicked, shouldn't both assets just be flying?
You would think so, but they actually serve completely different psychological functions right now.
Okay, how so?
Bitcoin is currently tracking risk sentiment. It acts much more like a high-beta tech stock in this environment. Yeah. Physical gold, however, tracks systemic institutional fear. When you combine an unexpected labor market failure in the U.S. with a physical naval blockade in the world's most critical energy choke point.
Capital gets scared.
Exactly. Capital doesn't look for digital risk in that scenario. It flees into the safest, most tangible, historically proven asset available.
So if I'm mapping this correctly, the Dow is struggling because of oil prices and supply chain fears out of the Gulf?
Correct.
But despite that geopolitical ceiling holding down the industrials, the technology sector seems completely immune. It is stubbornly pushing through all of this noise.
Tech is quite literally living in its own macroeconomic ecosystem today.
Let's look at the numbers driving that ecosystem. The Nasdaq 100 is leading the risk-on charge, up 0.2%. It is the only major U.S. future solidly in the green this morning.
It's acting like a magnet for capital.
It really is. And over in Europe, as we touched on earlier, ASML Holding is leading the tech charge. But here is the friction. We have analysts coming out with notes warning that ASML is getting frothy and is significantly overvalued.
Yeah, we've seen a lot of those notes this weekend.
And yet, the sources point out it boasts a robust 91 out of 100 GF score, and the buyers just keep stepping in. Let's clarify this. For those who don't track guru-focused metrics, what does a 91 GF score actually tell us about ASML's fundamentals compared to its so-called frothy price?
So a GF score, or guru-focused score, is an aggregate metric that evaluates a company based on its financial strength, profitability, growth, and historical value.
Okay.
A 91 out of 100 means that underneath the hood, ASML's actual business, its cash generation, its market monopoly on extreme ultraviolet lithography machines, it is incredibly sound.
Got it.
The warning about it being frothy just means the stock prices run up faster than the underlying earnings growth.
So investors are basically treating it like a luxury bond that also grows. They know it's expensive, but they are more than willing to pay the premium.
Exactly. ASML is the perfect case study for this specific environment. When you have cooling interest rate expectations, long-duration assets become much more attractive.
Let's define long-duration asset for equities, because usually we hear that term exclusively with bonds.
Right. In Wall Street speak, a long-duration equity is a company whose biggest cash flows are projected to happen years in the future.
Which is basically the definition of a high-growth tech stock.
Exactly. High-growth tech stocks fit this perfectly. When the cost of borrowing is expected to go down, because, the Fed might pivot, the mathematical present value of those future cash flows goes up.
Ah, I see.
So even if traditional valuation metrics say ASML is frothy, capital flows toward that growth precisely because the cost of capital is dropping.
We are seeing that speculative capital moving aggressively in the broader pre-market too. Avalon Holdings, ticker AWX, is up 10.4% on incredibly high pre-market volume.
That's a massive move.
Huge. But the real structural test of this market comes later today with the earnings calendar. We have a slate of companies reporting before the bell that couldn't be more fundamentally different from one another.
The earnings roster today really is a fascinating cross-section of the economy. We have ACM, Rocket Lab, Simon Property Group, ASTS, and AXSM all reporting.
Let's focus on two of those.
Yeah.
Looking at Simon Property Group, ticker SPG, my instinct is that they are going to face massive headwinds today.
Oh, without a doubt.
They operate physical retail malls across the country, they have commercial mortgages to roll over, and with the 10-year yield stuck near 4.7%, their profit margins are going to evaporate.
It's a brutal environment for real estate.
Right. Meanwhile, you have Rocket Lab, ticker RKLB, which is literally space tech, riding high sentiment after some recent launch successes. Am I missing something there, or is this just the perfect illustration of the rate environment? How do two vastly different sectors, space exploration and physical retail malls, both navigate a 4.673% Treasury yield?
You're touching on the fundamental mechanics of corporate finance there. The cost of capital acts like gravity for all stocks, but different sectors have very different aerodynamics.
I love that analogy. Break down the aerodynamics for Rocket Lab.
Okay, so for a speculative high-growth company like Rocket Lab, a 4.673% yield is all about the discount rate.
Right.
They are burning cash today to build rockets, and investors are betting on exponential future earnings down the road. When yields fall, which that 44% Fed probability suggests might happen, the discount rate applied to their future earnings drops.
Making those future dollars worth more today.
Exactly. That makes the stock mathematically more attractive today. Their survival depends entirely on access to relatively cheap equity capital to fund highly expensive operations.
So for Rocket Lab, the interest rate narrative is purely about how cheaply they can fund their runway to profitability.
Yes, exactly. But for Simon Property Group, it is a completely different, much more immediate mechanism.
Because of the debt.
Right. Real estate is heavily debt-financed in the present. Commercial real estate loans aren't 30-year fixed rates like a standard residential mortgage. They are typically 5 or 10-year terms.
Ah, so they constantly have to get new loans to pay off the old ones.
Exactly. They have to roll over that debt. When they originated a loan 5 years ago, rates were near zero.
Wow, yeah.
Today, when they go to roll that exact same debt over, the 10-year yield is hovering near 4.7%. That means their borrowing costs are skyrocketing overnight, which eats directly into their immediate profit margins.
Which is terrifying for a dividend stock.
Right. Furthermore, Simon Property pays a dividend. If an institutional investor can get a virtually risk-free 4.673% from the U.S. government, Simon Property has to offer an even higher, significantly more attractive yield just to keep investors interested in holding a brick-and-mortar retail stock.
That brings it all full circle.
Wow.
Space tech wants cheap money to build a future, and commercial real estate needs cheap money just to survive the present and compete with government bonds.
Exactly.
And both of their fates are entirely chained to that 44% probability of a Fed hike, which itself is chained to a 57,000 job miss.
It always comes back to the cost of money. And that dynamic is precisely why today's market action is so fractured. You have tech pricing in the relief of cheaper money, while industrials and real estate are choking on the present reality of energy costs and debt rollovers.
Okay, let's summarize the core dynamic for everyone as they watch the markets open today. We are looking at a market caught in a violent tug of war.
Very violent.
Pulling on one side, you have cooling U.S. labor data, giving domestic tech and Asian markets hope that the era of aggressive interest rates is finally ending.
Right.
Pulling on the exact opposite side, you have heating Middle Eastern geopolitics, with a naval blockade in the Strait of Hormuz driving up oil, acting as a tourniquet on the Dow, and pushing gold past $4,300 an ounce.
And it is crucial to remember that today's price action is really just the quiet before the storm.
Yeah, that's a great point.
There are no major U.S. macroeconomic data releases scheduled for today. The real test of this entire complex narrative is coming later in the week.
Right. We have Wednesday's Consumer Price Index, the CPI, and Thursday's Producer Price Index, the PPI. Those two inflation prints are ultimately going to dictate what the Federal Reserve actually does in September.
They are the final puzzle pieces.
Which leaves me with a final thought I want you all to mull over as you watch the ticker tape today. We just spent a lot of time discussing how a relatively tiny 57,000 job discrepancy, the difference between the 80,000 expected and the 23,000 actual, swung the Fed rate hike odds by 23 percentage points over a single weekend.
Just massive leverage on that one number.
If a miss that small can cause billions of dollars of institutional repricing, what happens if Wednesday's CPI inflation data completely contradicts the jobs data? Are we just one data point away from a complete violent reversal of this entire market narrative?
That's a very real possibility.
And if so, just how fragile is this current market optimism? Keep an eye on those resistance levels, and we will be watching the numbers right alongside you. Thank you so much for listening to the Bulls, Bears, and the Bell podcast today.
Make sure to stay nimble out there.
Absolutely. Please make sure to subscribe to Bulls, Bears, and the Bell on Spotify or your favorite podcast app so you never miss a deep dive. Have a great trading day, everyone.